Hi everyone, welcome to another honeystocks.com stock market outlook. This one's going out on the weekend of the 14th of May. And before I, of course, switch over to my screen share and walk you through a lot of the charts, I want to take the opportunity to thank everybody after the emails and messages from the analysis that I put out last week. I know that it's helped many of you get defensive. There was, of course, some short opportunities, some buy opportunities. So if you get some value from this week's analysis, please do hit the like button. A couple of things to get out there just off the bat is I'm not a day trader. I could not think of anything worse. My time horizon is generally weeks to months. Of course, it's a very fluid situation at the moment, ever-evolving landscape with the markets. So my time horizon has dropped down a little bit. But certainly if you get value from charting, I think you'll probably realise that there's a difference between many of us who put content out to social media. I like to keep things really simple, really clean, and like I said, hit the like button. So let's switch over to the screen share, let's dive into some charts and let's try and figure out what's going on. Now, before I get into the charts, as always, please do pause the video. Make sure you're comfortable with that before watching any further. Basically says there's not any investment advice. Please do your own due diligence and don't be silly. A little bit of credibility for myself. I'm working my way towards my CMT. Technical analysis is something that I'm widely known for in professional circles. A few of my big recent calls, valuation reset back on the 3rd of January, failed breakout in small caps, which essentially got the ball rolling with the correction crash and what we're seeing at the moment. Again, S&P 500 put in a massive failed breakout back in January, again on top of it. And if you want to go back a little bit further, front and center on my website, you can go and see the analysis that was provided to our clients and members in the 10 days leading up to the stock market crash in 2020. If you're in the process of learning, technical analysis, market breadth, etc., you might find a lot of use from that. And if you do get some value from this, as I said a minute ago, please hit the like button. It helps to get my work out there. I do this completely for free. I don't get anything for it. So please do hit the like button. So let's start with the major averages. Now, I will spend just 5 minutes quickly walking through the broader market. I think it's very, very important at the moment. And of course, as always, I have around 20 individual names that you can probably add to your watch lists. There's something for everybody this week. There are stocks rebounding off logical support levels, there are breakouts, and of course there are short ideas on some stocks that are not doing so well at the moment. So with the 4 major averages, I've just condensed the charts just to give a good visual. I think the S&P 500 is actually, when we look at candlestick charts, this is probably looked on reasonably favourably. They don't always work out, but the potential here is that the S&P 500 could put in a potential failed breakdown. That's the hope. I think those of us that prefer taking buy positions than short positions are probably looking at this. And of course, I think when we look back to the crash of 2020, where we had, these V-shaped recoveries, now this, let's call a brutal correction, I prefer to call it a crash, has just been a lot more prolonged. So it's been very, very challenging, certainly having to sit out the market, bat singles. It's not a case, at least for me and certainly my client base, that, you want to be aggressively long or aggressively short. There are little hiding places that you can, take up in the market. And again, I have a few of those prepared, but certainly the Dow could potentially move higher next week. Those would be bullish developments for the market within the overall context that we have to understand that we're pretty much in a bear market. When we look at the small caps, I got a lot of attention this week because I put out a tweet just essentially saying that, you know, if I was in control of the stock market and looking to frustrate everybody, I'd look to buy up all the beaten down names and tank big tech. Now that's exactly what we've seen on Thursday. This was posted on Wednesday, and on Thursday that's exactly what we've seen. Now when we got into Friday, of course we've had a massive rally in a lot of areas of the market. Hopefully you've done okay out there and you've realised that this is a very important chart. This is a Russell 2000 small caps bouncing off a very, very clear and obvious level that you would want to pay attention to. The small caps are 31% off from their peak in November. So we can say that the small caps have crashed. We know that they declined 44% back with the COVID crash, but I understand that this crash probably feels a lot worse just because it's been a slow grind, whereas this was just quick and violent, which I think most of us that do this professionally would just prefer to get it out the way and then get on with the recovery. So this is a logical turning point for the Russell 2000. Now, I am just treating it as a bear market rally at the moment. I'm looking everything through the lens of risk to reward propositions. This is the Dow. Again, the hope is that we can start to kind of move higher over the course of the next week or two. Something to say that with bear market rallies, they can last a week, 2 weeks, 3 weeks. Will that be the case, or will we get a massive recovery and go and hit new all-time highs by the end of summer? I am absolutely open to all possibilities. The market is not as simple as a few lines on a chart and looking at individual candlesticks. I think what we have to understand is that if we look at through the lens of the risk to reward proposition, we already understand that the S&P 500 is trading below its 10-month moving average. This has historically been a problem going back to 2000. 2008 has been a big problem. It was obviously a big problem with the COVID crash. And of course, we have to couple it with the potential for a failed breakout here. And of course, I like to use Fibonacci on long-term charts especially. And we are trading below that 10-month moving average. I know, there's certainly a lot of professionals, money managers, etc., that really stay out the market when we are below these key levels. So something to pay attention to. It doesn't mean the market can't bottom and go on and, like I said, put in new highs, but it is very, very challenging at the moment. We've got the technology names, the triple Qs, threatening to put in another breakdown, but it has rallied on Friday there. So what happens next week? I think when we look at things at the index level, I don't think anybody really knows what comes next. But if you are looking for areas that certainly hiding places, the US dollar index is breaking out. Now that would be considered a bit of a headwind for US equities, but doesn't mean that they can't all rise together. And of course, dollar index is breaking out. Now this chart got a lot of attention as well last week, just highlighting that with the 10-year Treasury note yield pushing up against its 2018 highs, which of course couples with the lows in the 20-year Treasury bond ETF TLT, this could be a potential turning point for long-dated bonds. And of course, this could be a pause for the 10-year Treasury note yield. So it will be interesting to see how these charts develop. I think if the 10-year breaks out above those 2018 highs, that's of course a problem for TLT. You would think that something like TLT would be considered a bit of a flight to safety. That hasn't really worked out well over the last couple of years, so we'll see how this chart develops. If it breaks down, then of course it's a short. But one of the reasons, certainly when we look at the small caps, where we're looking for rebound levels. I like to pay attention to the consumer discretionary chart, which is relative to staples. Now, what I like about the chart is when we get into these extreme readings in this ratio, it can tell us that there are, turning points coming in the market. So when the consumer discretionary relative to staples reached an oversold condition this week, that got me starting to think about charts from a bullish lens. And, from that, certainly many stocks were massively oversold, which of course has resulted in massive short covering. If we look at something like, I'll just flip over to Coinbase here, massively beat down, huge distance from its 20-day simple moving average, and massively oversold. Put this out into our chart community this week, just highlighting on Thursday morning that coin was being bought up, and obviously Travis quite liked that one, but certainly that one's playing out quite well at the moment. So it's not something that I have any conviction in over the long term, but certainly as a bit of a mean reversion trade short term, maybe for a few days, a week or two, certainly very profitable. But let's start off with Apple. Now, Apple is, of course, I think now it's actually second or third biggest company in the world. I think the Saudi oil firm is now the biggest company in the world. But certainly this is how I'm looking at charts at the moment, just looking for basic support and resistance levels. Apple is bouncing from a logical level. It did break a long-standing trend line last week, but it has pulled back to a level now where, certainly if you were short on Apple, that would be a level to consider profits. But, if you're bullish on Apple, which I think most of us probably are over the long term, you could probably consider it a good buy point. And if you are taking a new position in something like Apple, what I like about basic support and resistance is it just allows you to define the risk a little bit. So you can always, get out with minimal damage. Also, just to draw your attention to something, I think there's a misconception, I think, with many of you who follow my work. I actually pay attention to the fundamentals of companies. These are the metrics that I keep an eye on. It has kept me safe in the market, and certainly with the companies that are in distress, looking for high PE ratios and negative earnings growth, and a lot of those names have been killed. But AMD, again, another chart that I'm looking at with a bullish lens at the moment, certainly massive rally. I think there's a potential here for a double bottom breakout. So I think I've added a 50-day simple moving average to the chart. The reason for that is we can often find in downtrends that the 50-day acts as resistance and price falls away. So I think when the market opens on Monday, I suspect that AMD's, the 50-day will be down at around 100, 101. And I think if it can break out above 101 and that 50-day simple moving average, I think, again, it might be one of those that you might want to consider for, certainly a short-term rebound idea. Same with Block Inc. Again, it's got a super high PE ratio, so it's no surprise to me whatsoever that it's been killed. Now, negative 12 months earning growth, that we all know what's happened with cryptocurrencies over the last week. They have a lot of Bitcoin on the balance sheet. So I think what happens with Block will be determined what happens with Bitcoin, given the strong correlation with the charts. If you go and overlay the Block chart onto Bitcoin, the charts are very similar, so they run in tandem. So I think what happens this weekend with Bitcoin will probably determine how this chart opens on Monday. Certainly there are two schools of thought: mean reversion, failed breakdown, rip higher, or are we just getting a short-term bear market rally followed by a decline at a logical level? So we'll see how that one opens up on Monday. I've already talked about Coinbase. Not good news for Microsoft. Yes, I know it's a great company. I love it too. But certainly it's broken down this week below a key support level for my work. So need to pay close attention to this one. We've got emerging markets. We all know, I'm sure, that emerging markets is essentially 40 odd percent China. But for me, emerging markets have broken down below a key support level. So I think if emerging markets is below $41, I don't see the case to be made for being bullish. Of course, if we move higher, you could probably revisit that thesis. But again, below these levels, I don't like it. Now, I'll just touch on the metaverse names now. Again, this chart got a lot of attention. I think most of you watching understand that I don't use the magical hindsight indicator. I put out this tweet on the 4th of May just saying nobody's going to live in a metaverse, the stocks are garbage. Now, yes, I understand that Unity and Roblox are, they have a business. I understand this. But again, when we look at things like PE ratios and earnings growth, etc., that's the way that I was looking at this. Now, I got a lot of, let's just call them nasty emails and messages. But we've had earnings. Earnings are out the way. Unity has declined 54% from this tweet. Now, obviously, Roblox has recovered quite well on the back of earnings. So I think if Roblox can get back up above its levels, then that one is probably more interesting to me than Unity. Now, certainly if you've had put options, which many of our clients and members have had over the last 10 days, congratulations, you've made an enormous sum, hopefully. But certainly I'm not willing to change my views on the metaverse names at the moment. Roblox perhaps. But given the number of messages and emails that I had on this particular chart, many of you reaching out to thank me as well, but certainly it's not an area that I'm remotely interested in. I'm more looking towards areas that are holding up well. I think energy makes a lot of sense. I think if you like chart patterns, ConocoPhillips looks like it could be putting in a bit of a cup and handle pattern. We already know that Williams Costs has already broken out, so that will be interesting to see what happens next week. We've got Dow Inc. again holding up incredibly well, massive earnings growth, low PE ratio. These are the types of charts that I like at the moment, just from a bullish lens. Easy to figure out where the bullish thesis starts to fall apart. So again, Hewlett Packard Bell held up incredibly well. I like it above $18. Antero Resources taking a little bit of a hit this week, along with natural gas, but certainly pullbacks and uptrends oftentimes offer opportunity, is something that my clients often hear me say. Still have a $45 target on it. If we just simply add in, maybe a level, if you are looking to manage risk and maybe think about profits. I mean, it does look like that $31 level has some kind of support. So certainly risk to reward, you could probably take a buy position and have a stop just below that $31 level. Lithium Americas, again, negative earnings growth. It's broken down. It'll be interesting again. A lot of the charts that I have on my watch list at the moment are looking exactly like this, where we're looking either for a bearish decline or a bullish failed breakdown. So this is the thing with technical analysis. It's not this magical tool that tells us what direction a stock is ultimately going to go, but it does help us to balance out risk to reward probabilities. PayPal, again, looks like it could be potentially taking another leg lower. I did cover this one last week. This candle, of course, a lot of candles are looking like this at the moment, just with the rally that we had on Friday there. But certainly, if we're below these market crash lows from March, then I think it's a bit of a problem. Rebound spectacularly. Lam Research held up very, very well over the last few weeks. Again, I think fundamentally it looks pretty solid, which is probably why it's holding up. So I think as long as it's above 450, I think you can remain bullish. If you like commodities, certainly you have the commodity index, which could potentially be looking to break out above $29. I covered this chart last week. I like it very much. This was a chart that was provided to our clients last week as a bearish breakdown. Now, I know that there's a few of our clients and members have been actively taking profits on this, and it does look like there's a bit of a bullish candle here. So I think if this rallies next week, I think you probably want to see it above $69. Again, Cloudflare, I'm looking at this from a bearish lens, just purely for the fact that there's no PE ratio and negative earnings growth. So I'm looking for a bearish retest. I'd like to see this move into around the $76 level, and I'd probably look to take some puts on Cloudflare. We've got Dexcom. I covered this one last week as well. Massive breakdown, and of course we're probably looking at this one as for some kind of bearish retest here. Again, really high PE ratio and negative earnings growth. SoFi, thank you to those of you that reached out, and I know that there's many of you that done very, very well on this. I posted this the other day, just because I understand, certainly the market was due to rebound, and that's exactly what we've seen, especially in SoFi. I think it's up 25% from the post, just as a rebound idea. It's nothing long term. I don't know what happens with SoFi long term. There's no PE or earnings growth there, so I'm not sure where it goes. But what I do know from the chart is that 50-day simple moving average is a problem. So I mean, if you're technically minded, I'd suggest adding the 50-day simple moving average to the chart, because I think there's probably question marks if it can get to that $758 level. Massive rebound in ARC this week. Again, those of you that follow me know that I was bearish on ARC on this breakdown, and of course ran into a very logical support level. I understand for many of you watching this that you probably won't be watching as many charts as maybe what us professionals do. But these are the charts that are available to our clients and members in our sector workbook. I have an ETF workbook that is available to clients and members in our chart book on my platform. So I update it every few days, just with key support resistance levels as well. So feel free to go and have a look at our website. But MGNI, certainly looks like it's moving back up above a key level. It has closed above its 20-day simple moving average. Again, really high PE ratio, but certainly it doesn't mean that you can't profit from stocks that are rebounding in a bear market. And I think with MGNI, potentially it could be a bottom, but certainly I'm looking at this one just purely as a short-term idea, but maybe worth adding to the watch list. Shopify, again, probably looking at this one as a short-term idea. If we do get a rally next week, we know that Shopify has been killed over the last few months. Really high PE ratios, which is something that I think many of us are understanding now, that these stocks with massive valuations are being brought back down to reality. So yeah, I think potentially that this could rally into that $500 level. I would expect that the 50-day to continue to move lower here, but certainly it might be one of those for a short-term idea. I think Micron technology makes a lot of sense. Certainly it looks like this is holding firm here. We already know that with range-bound names, it's very, very straightforward. You buy at the bottom and you sell at the top. That's not a bad number. And of course, there's an easy out. It's one of those stocks that's held up very, very well. It is a high conviction idea that was sent out to our clients and members a few weeks ago. It has been holding up very, very well. I'm still confident in the chart, but of course, if it breaks down below these levels, it's probably a chart where you might want to take defensive action and maybe load up on some put options. Kraft Heinz showing up in my scans this weekend. Looks potentially like it's ready to break out. Consumer staples name, which is a traditional defensive area of the market. So I think that's worth looking at. I think American Express is starting to make sense. It's in this massive sideways range. But over the last 2 days, it's rebounded from a very logical level. And we also have Nike, which is 41% off its highs. It's rebounded from an area where you would absolutely expect it to rebound. So again, if you like Nike, I own many pairs of Jordans, and very easy to define the risk. If it breaks below these previous lows, no problem, no chances taken. So I think Nike, I think you can certainly add to your watch list. But what I would say is the market is, of course, very, very challenging at the moment. Many of these charts could, alter by, close of play on Monday and look very, very different. So, if you are somebody that is struggling out there, maybe you don't have the understanding, maybe of technical analysis or risk management, etc., feel free to stick around for a minute or two. But if you did get some value from that, please do hit the like button. Like I said, I do this for absolutely nothing. So the cost of entry is that you hit that like button and let me know what stocks are on your radar. It would be much appreciated. But just to quickly run through what it is that I actually do. I run a technical charting service, provide our memberships to our clients and members. We provide our premium weekend analysis, really a shortened version of what you've just watched. Provide trade ideas, we provide a midweek halftime analysis, provide access to a wonderful trading community, provide charting support on a daily basis, as well as access to our technical analysis program, which is also included with all our memberships. And of course, you can join 7 days risk-free. If you don't find value from my work, we issue refund, no questions asked. So feel free to check that out. But I'll just quickly show you what it is that I do. This is what a typical high conviction trade idea looks like. This is Micron technology. You'll see that there's very, very clear parameters in place. Obviously provide guidance on these charts. So once the high conviction alert goes out, I then cover it in the midweek halftime analysis and also the weekend analysis. And if it's a chart that I think is showing signs of fatigue or signaling to maybe get out, then I will communicate that to our clients and members as well. This is another recent one for Williams Cause, which has been holding up very, very well. Cloudflare was an absolute rock star last year, like a lot of growth tech. Square Inc. Hit our upside objective back when it was up at $200, $300. Zscaler, Rockstar, AR. Yeah, I've been covering that one since $5 for our clients and members. Obviously, that's up at $35 now. So that's really what I do. I'm very, very unique though, because every single idea that goes out to our clients and members, I log it on my website for complete and open transparency. So if you are thinking about signing up for our service, go and check that the charts that I like to recommend are the types of charts that you like to buy. I'm not recommending penny stocks or pump and dumps or anything like that. It's good quality companies, both on the long and the short side. We also have access in our chart book where we have access to our commodities section as well, which has recently just been added. I am adding lots of features to my service, which has been greatly received from our existing clients and members. So stocks, commodities, and currencies as well. So feel free to go and check that out. But I think if you are really looking at the stock market, maybe with a mid-term approach, absolutely do not sign up for my service if you're a day trader and you're scalping on minute time frames or day trading. It's really not the best fit for my work. I think if you have a mid-term approach, it's probably a good fit. I think if you're looking to get away from day trading, I think if you are looking to maybe learn technical analysis for the mid-term approach, I think if you're someone who's maybe too busy to keep on top of social media charts, and maybe you've got work, family life, maybe you just want to be part of a community, certainly it's probably worth giving the website a look over. But if you've stuck around to the end, don't forget to hit the like button, and thank you very much for watching, and feel free to pause the video and have a look at the wonderful testimonials that have been sent to me over the last few months. So thanks very much for watching, and appreciate it. Thanks.